rich are greedy. Isn't that true?" I nodded, saying, in so many words, "The reason he says that is because he thinks the rich should pay people more and more the longer they work at a job. He calls it seniority or tenure. Is that correct?" I nodded. "But can you understand that for the most part, the person is often only doing the same amount of work or doing the same job?" asked Mike softly. "I understand that," I replied. "But my dad does not see it that way. He truly believes in pay raises based on loyalty and longevity." "So your dad thinks the rich are greedy because they will not pay for loyalty and longevity. Isn't that true?" "He does," I replied. "Can you see how wanting more money for doing the same amount of work can be greedy?" asked Mike. "Or wanting to be paid overtime, or wanting to be paid extra if the job the person does is outside his job description." "But that is how people in my dad's world earn their money," I said. "It is their reality." "That is the word," said Rich Dad. "The word is reality. We come from different realities. In my world, to ask for more money to do the same job is greedy. In my world, if I want more money, I first need to do more and more for less and less money, for more and more people. Then I become rich." "That is why your dad has a bigger house than my dad," said Mike. "My dad has spent years buying and building apartment houses so he could serve more families with more and more affordable housing. If not for people like my dad, many lower-income families would be paying more and more rent because there are so few apartments available. Your dad worked hard to buy bigger and bigger houses for himself and his family. He provides houses for no one else, and yet he thinks that the rich are greedy. It is your dad's reality, but it is not my dad's reality." Mike and his dad were doing their best to point out the differences in the words greedy and generous to me. At the age of 20, I was beginning to make a shift in my reality. I knew that I could choose the reality I wanted, and the reality I was choosing was the reality of my rich dad. And that reality was that many of the rich were generous. I knew that from here on in, if I wanted to become richer, I first needed to find out how to be more generous. How to work less and earn more. "If you want to get rich," Rich Dad said, "don't ask for a raise. Instead, begin to ask how you can serve more people. In fact, if you get a raise, you are working for the wrong kind of money." Most people are not aware that there is good income and bad income. When you ask for a raise, you ask for an increase in bad income. If you want to retire rich and retire young, you need to work hard for the right kind of income. In earlier programs, I discussed the 3 different types of income, which are, first, earned income, income that comes in the form of a paycheck. It is also the type of income you ask for more of when you ask for a raise, bonus, overtime, commissions, and tips. Second, portfolio income is generally income from paper assets such as stocks, bonds, and mutual funds. A vast majority of all retirement accounts are counting on portfolio income in the future. And third, passive income is generally income from real estate. It can also be royalty income from patents or for use of your intellectual property such as songs, books, or other objects of intellectual value. In Rich Dad's mind, the worst kind of income to work hard for was earned income for 4 main reasons. 1. It is the highest taxed income, and it is the income with the fewest controls over how much you pay in taxes and when you pay your taxes. 2. You personally have to work for it, and it takes up your valuable time. 3. There is very little leverage in earned income. The primary way most people increase their earned income is by working harder. 4. There is often no residual value for your work. In other words, you work, get paid, and then have to work again to be paid again. Again, to Rich Dad, there is very little leverage in working for earned income. Why Rich Dad liked passive income. Although he did receive all 3 types of income, if given the choice between the 3, he would take passive income all the time. Why? Because it was the income he had to work the least for. It is often the least taxed, and it earned him some of the highest returns consistently over a long period of time. In other words, he worked hard for passive income because in the long run, he worked less and less, served more and more people, and earned more and more the older he got. Kim and I were able to retire early because our plan had us working hard for passive income, not earned income. Another difference is that we planned on retiring with more passive income and not portfolio income. While most people retire on portfolio income, it is not always the best because it is the second highest taxed of the 3 incomes, and taxes are your largest single lifetime expense. My Rich Dad had all 3 types of income. The reason he had all 3 was because each type of income had different advantages and disadvantages. Let me explain. 50% money. Rich Dad often called earned income, the income you receive from a paycheck, 50% money. The reason he called it 50% money was because no matter how much money you earned, the government always took at least 50% of it or more in one way or another. If you make $50,000 a year today, then at least $25,000 may go to the government, most of it before you even get your hands on it, through withholding. Even after you receive that remaining $25,000, the taxing continues on. As most people know, you are taxed when you earn, spend, save, invest, and when you die. From Rich Dad's point of view, it was not very smart to work hard and have the government take at least 50% of what you worked hard for. 20% money. Most people today are attempting to retire utilizing what my rich dad called 20% money, which is money from capital gains or appreciation of stocks and sometimes real estate. 0% money. One of the reasons Kim and I retired early was because we utilized tax-deferred money, what my rich dad called 0% money. Tax-deferred money is money from capital gains that is not immediately taxed. It is deferred for as long as we choose to defer paying those taxes. For example, we put down $5,000 and purchased a house for $50,000. 2 years later, we sold it for $100,000. We had a capital gains consequence of $50,000, but we chose not to pay the 20% in capital gains, which would have been approximately $10,000. Instead of paying the capital gains tax, as you would if you had made the same amount from a stock or mutual fund, we deferred our gains and rolled $55,000, which was $50,000 in gains plus our original $5,000 down payment, into our next investment. In other words, we had a 1,000% return in 2 years and paid no immediate taxes. We legally deferred our taxes and used what was technically the government's money as a down payment on a larger apartment house for $330,000. We then used the bank's money and some of the seller's equity to help us finance the remaining $275,000 we did not have. Not only did we use OPM, other people's money, we used government money to help us retire rich and retire early. Between 1988 and 1994, we utilized this investment and tax strategy many times. The reason the government allows these tax incentives is to keep the real estate industry vibrant and help the nation's economy stay strong, since real estate makes up a large sector of the U.S. economy. Tax-free money. There are many ways to earn tax-free money. One way is to invest in tax-free municipal bonds. An example would be a person who puts $1,000 in a tax-free bond at a 5% interest rate. That means that each year this person will receive $50 tax-free. While it may not sound exciting, there are many times when such a return is desirable. Tax-free money from 0% money. Another way of deferring taxes is by taking the depreciation from the improvements on your property. For example, let's say I buy a $100,000 rental property. The land is valued at $20,000 and the building is valued at $80,000. The government allows me to depreciate the building and not pay taxes on the amount of that depreciation. Let's say the government allows me to take a 20-year depreciation schedule on the $80,000 improvement. In many ways, that offsets $4,000 of extra income I do not have to pay taxes on in that year. When your portfolio is in the millions of dollars, that amount in just depreciation, when combined with other losses that are not really losses, can be significant. One method the rich use to legally receive tax-free money is to simply keep deferring their real estate capital gains and then at the end of their lives roll that real estate into something like a charitable remainder trust. The moment they do that, they may never have to pay tax on all the capital gains or depreciation they deferred and used for much of their lives. Competent advice. When making any financial decisions involving these issues, my best advice is to seek competent advice. I am not a tax attorney, a tax accountant, or an estate attorney. These are highly specialized and complex areas of law that require the best advice you can find, especially if you are rich or plan on becoming rich. As Rich Dad often said, the most expensive advice you can receive is free advice. It is advice from your friends and relatives who are not rich and have no plans on becoming rich. But remember, not only can you receive bad advice from friends and family, you can also receive bad advice from so-called professional financial advisors, bookkeepers, accountants, and attorneys. So choose your team wisely. The best loophole of all. The best way to earn more and work less is via owning your own business. It continues to be the best loophole in the world. An employee today pays for many of life's finer things with after-tax dollars. For example, most employees have to pay for their car with after-tax dollars. A business owner is allowed to pay for his or her car with before-tax dollars if it is used for business and meets certain requirements. When you are working for 50% money, your car can be far more expensive than your boss's car, even though your car costs less. Even such things as football tickets, trips or dinners, daycare for your kids, and other benefits can often be purchased with before-tax dollars if they qualify as legitimate business expenses, and they may be subject to limitations. A word of warning. This program is only to make you aware of some of the differences in income. I caution you because it is legal to reduce taxes as long as you use these tax strategies in the pursuit of making more money. If you utilize these same strategies only to minimize taxes, then you are technically breaking the law. This is a very important point and is why I recommend you seek the best tax advice possible. As you look the numbers through, you might find that the price of job security is very expensive. Even if you have a steady job and a 401k, you might be losing out. The problem with the 401k. Although I recommend that everyone have and maximize contributions to a 401k if they qualify for one, there is one major flaw I see in it. The flaw is that although you save your money in it, and it hopefully grows free of the 20% capital gains tax, when you withdraw it at retirement time, you are taxed at the 50% tax rate of earned income. Even though you believe you are investing in portfolio or 20% money, when you cash in, you are still taxed at earned income rates. The second problem with the 401k is that it only works for people who are planning on being poor. If your income remains high after you retire, you continue to pay higher taxes on your retirement money because your income went up, not down. Similarly, the problem with Social Security is that it only works for people who want to be poor. If after you retire and you find that Social Security is not enough for you to live on, and you go to work for earned income, the government will begin reducing your Social Security payments. In other words, the only way to receive a full payment is to choose to be poor in most cases. So what if you simply save your money? For people who believe in keeping all their money in the bank, thinking that saving is smart, their money is working